It's Friday, February 7th. It's time for Retail Now with RNG, the weekly show where we cover news and insight about what's happening now in retail. Lots to cover this week. CVS is removing tobacco from its stores by October. Coca-Cola invests in Green Mountain, makers of the Keurig line of coffee. Winco is expanding in Texas. Radio Shack does the Super Bowl. Doug has a request of the week from RNG's clients, and we'll update you on what's coming next. All that and more on Retail Now. I'm Keith Anderson, and I'm joined this week by a few folks from RNG's advisory team and client engagement team, Hannah Donoghue.
Happy Friday, Keith.
Thanks, Hannah. Good to have you with us again. And Doug.
Hello, everyone. Thanks for having me. I started with RetailNet Group about 3 years ago, and I've worked my way up from the research analyst. I've spent some time on Hannah's team in Latin America, and now I work extensively in client engagement.
Both these folks also represent RNG's fashion line. Each is modeling a version of our apparel that you can buy in the RNG store. But let's go ahead and get started. First up, probably the biggest story this week is CVS's big announcement. They've got a big New Year's resolution. They're quitting tobacco this year. And some of the basic facts are they expect around $2 billion of sales lost this year and annually going forward. About $1.5 million of that is going to come directly from tobacco, and about $1.5 billion comes directly from tobacco. $500 million comes from purchases tobacco buyers make on other trips, and they think it's going to carve about 17 cents off of earnings per share annually, although this year, since tobacco will be in the stores until the end of the year, it'll only be 6 or 9 cents per share. But it's a bold move. They get the first mover credit. I think it goes a long way towards improving the brand as a destination for healthcare and health solutions. And I think it also really positions CVS as a place that you go for more than just products. And it's interesting because at the same time, there are some other retailers like the discounters, especially Dollar General and Family Dollar, that are actually adding tobacco. And what we know about Dollar General's journey with tobacco is that when they added it, about a third of tobacco purchases had only tobacco in them. About a third were what Dollar General calls a Coke and a smoke. So cigarettes and maybe some chips or soda, one item, maybe two items. And about a third were part of a bigger basket. But in the third quarter, the percentage of purchases that are more than just tobacco went up to 46%, and the percentage of tobacco-only purchases went down to 24%. So it's good news, I suppose, for those players, but ultimately, 3/4 of tobacco sales are still sold in convenience stores. So there may be a little bit of an upside for Dollar General and Family Dollar and Walgreens, of course, if they decide not to follow CVS, might have a nice opportunity to pick up a little bit of share. But the question I have is, do you even want that tobacco market share? The reality is, if you've got a positioning as a healthcare-oriented retailer, it's pretty difficult to reconcile the sales with your overall brand position.
Yeah, I think from a branding standpoint, as they look to really win on well and expand more into different healthcare services, it really aligns well with their achievement or going towards wellness. It makes sense.
Yeah. The other thing that's sort of unresolved that I'm not sure we have an answer on yet is what the implication is for categories that are directly adjacent, like e-cigarettes. Those aren't really carefully regulated yet, so there may be a role for those. But the other really important question I think a lot of manufacturers have in categories like alcohol and spirits and even candy and other categories that have some health-related implication. The good news from Larry Merlot, CVS CEO, is that in moderation, those categories don't have the same profound health effects that tobacco does. So for the near term anyway, it seems like most of those categories are safe. But I think the big picture is there's clearly an ongoing commitment to supporting wellness and preventing as opposed to only reacting to health conditions. And whether or not your category of merchandise is directly impacted, CVS and many retailers are positioning as destinations for more than just specific products.
Yeah, I think the other thing that'll be interesting that I don't think is solved for yet, but from a front end standpoint, when that category space opens up, who will that go to?
Absolutely. And a lot of companies really have to get out in front of this kind of a space reallocation and justify the reason their category deserves more space,
Right.
why shoppers need it, everything from the attitudinal and behavioral motivations to the economics the category brings to the building.
Yeah.
And I imagine you'll talk a little bit about that approach at the Small Store Summit in April, right?
We will, yeah. So that the summit will be focused on, looking at drug, looking at convenience, and many of the small format channels that are growing. And as these channels shrink their stores and big boxes shrink, one of the big topics that we're discussing is space reallocation and how, from a vendor standpoint, you win that space in an increasingly compressed environment. So we'll definitely be covering it there.
And we just added a few speakers, didn't we?
We did. We just added, we have added the director of merchandising from 7-Eleven, and we've also added, we spoke a little bit about it last week, but Aaron Rubinson will also be joining us from Wolf Research, and so we're really excited. And then we mentioned last week again, but Derek Gaskins will be there. He works at Rutter's, one of the leading convenience superstores. They're very innovative from a food service standpoint, loyalty as well. So we're really excited to have them joining us.
Awesome. Well, Hannah, the other big story is Winco's expanding into Texas.
They are. So Winco's expanding into Texas. It'll be their 8th state. They're just opening the first 2 stores, expected to open another 3. The first 2 stores, some of the quick facts, are about 95,000 square feet. The next 3 will be a little bit smaller, closer to 85,000, but that's just based on geographic location. I think really the biggest implications are thinking about the discount competition in Texas, whether it be Walmart or Aldi. Walmart's already started to face increasingly competition there from Aldi when they entered in 2010. Five Below, from a GM and treasure hunt standpoint, came in last year. It makes sense with the market, with the demographics of the market, lower household income, median household income, higher percentage of the population that lives under the poverty line, and a younger population. So from a demographic standpoint, it makes sense why Winco's going there. And I think just, from a pricing standpoint, the competitive environment will intensify.
It's such a unique format. You really can't compare it directly to any other building in the U.S. And like some of the other privately held growth formats that we pay a lot of attention to, they're incredibly deliberate about where they expand and how they expand. And I learned a few months ago, Winco's footprint overlaps 85 or 90% with Walmart. So I think you're exactly right. When you call out that competition between Walmart and Winco has such a unique approach to building assortment and competing on price. I think it is one of the very few incredibly formidable competitors that can not only stay on even footing with Walmart, but can serve as a threat.
Yeah, and it'll be worth to watch. So Winco's typical model is they'll open up 15 stores and then drop a DC there. So the thinking is that one will come into the DFW area within the next few years. So it will be one to watch going forward.
And we've got some of our field researchers visiting the store over the next week, and we're going to do a pricing study, right?
We do, and we'll be publishing on that next week, a pricing study comparing some of the low-cost operators in the market. So that will be published and available for everyone next week. So we're excited to see the results, and we'll also have photos of the new store. The stores that they opened in Dallas are using their new store experience. A little bit easier to navigate, better sight lines and lower fixturing in some sections as well. So we'll feature those too.
I'm looking forward to it. One thing that I've heard is that even though Winco historically hasn't really emphasized private labels, they've used a lot of sort of off brands that they access through distributors and that sort of thing. It appears that they're starting to get more serious about private label, and this Texas expansion may be the first time we see that. So I'm pretty intrigued to see how they're rethinking the role of Winco-owned brands in the format going forward.
I think they'll have to. With Aldi being so strong in the market and their private label, I think it will be something that they'll need to emphasize in the store.
Yeah, absolutely. Well, another big development this week was Coca-Cola's investment in Green Mountain, the maker of the Keurig coffee brand. And they took about a 10% stake in the brand, $1.3 billion. They have the option to take their minority stake up to, I think, 16% over the next 3 years. So it's a significant relationship, and it gives Coke exclusivity with Green Mountain for their brands in certain categories for the in-home, do-it-yourself, cold beverage product machine that Keurig / Green Mountain is launching as early as October this year. It's not entirely clear when that machine is going to launch, but it'll complement the installed base of 30 million of the current sort of version 1 Keurig coffee makers that are in homes and offices globally. And sometime this year, they're releasing a Keurig version 2 coffee maker. So it's in many ways being interpreted as a response to companies like SodaStream, that has grown pretty quickly over the last several years, based in Jerusalem, doing some aggressive marketing. You may have seen it during the Super Bowl. And what I find so interesting about this is it will certainly be important to the category itself. And I'm sure some of the other big carbonated soft drink makers are going to react somehow. But what we do know about these coffee cartridges is they've performed incredibly well on the web. So programs like Amazon Subscribe and Save and those auto replenishment models, where you basically set it and forget it and get these highly replenishable products delivered to you all the time, really good for the brands that participate, because you essentially lock a household into your brand. And you can drive some incremental consumption, because if it's there in your kitchen or in your office, you tend to consume it. And it just keeps on coming. And if there's not enough, you might actually push the next delivery even sooner. So it can be really good for the brand. And it's obviously good for the retailer, because it locks somebody into that category with that retailer. But in this case, the possibility is the cartridges may or may not be purchased through a retailer. That is, it does open up a direct-to-consumer channel potentially, and it's going to be interesting to see how that plays out. It's also interesting because Keurig has started opening their own brand stores in malls, and I've got to believe they're going to be merchandising this new machine in those stores too. So it's still early days, but there's certainly a direct-to-consumer element to what's happening here. Well, Doug, tell us a little bit about the Super Bowl and specifically Radio Shack at the Super Bowl.
Yeah, so those of you that still had the TV on after halftime, you might have seen Radio Shack poking fun at themselves. They ran an ad basically saying, the 80s called, they want their stores back. And turns out that's a precursor to the announcement they made earlier this week. They're going to close 500 stores in the U.S., which is about 10% of their total store base here. And they're going to be sort of re-imaging and renovating the remainder of their stores for something, we'll say, more appropriate for the 21st century. So they've already got concept stores out there. The RetailNet Group was actually in one at the end of 2013, this concept store in Philadelphia that we walked through. And you certainly see this complete reorganization, re-merchandising of the entire store. So products are now organized kind of by function. So you see a Play It department, you see a Power It department, a Connected department. So much cleaner, much more user-friendly, I would say, and kind of more concentrated merchandise than maybe they've had in the past.
It isn't the issue with these stores on some level, Doug, that the iPhone is basically consolidated 90% of what Radio Shack sold in the 80s into a single device. Basically, video cameras, phones, calculators, computers, compasses, GPS. You know, I look at Radio Shack, and the closest comparison is a format like Best Buy Mobile. And that's a format that Best Buy is doubling down on, and it makes sense to me because it's picked a handful of product categories. It offers a pretty complete assortment with some value-added services that surround the merchandise, and you can go talk to people who are knowledgeable about the differences between different handsets, different carriers. You can get extended warranties. It sort of adds up. If you're somebody who, for example, is trying to launch a podcast and you need a microphone or a video camera and you go into a Radio Shack, you may find they do have those products available, but there's one option in the category.
Mm-hmm.
And so you walk around and there's 1 up to 4 choices in 40 categories. And it's really difficult when you look at the lack of selection and you look at the overall price gaps that you see between Radio Shack and folks like Amazon and Best Buy and really anybody who tends to just dominate them on assortment and price. And it's just tough for me to imagine that simply reinventing the store experience is going to be sufficient to position Radio Shack for much of a comeback.
So if you were to ask their leadership, this week they still said they think Radio Shack is a 4,000 unit format in the US. This 500 closure will get them pretty close to 4,000, a little over. In the store, you certainly see a lot of innovation or changes going on with their merchandise. Categories that are really vulnerable to online, things like toys, some accessories have been shrunk way down to 6 or 8 feet of shelving space. And you see them following this trend that Apple probably revolutionized, but a lot of these consumer electronics players have really been pushing into. Verizon, Best Buy, all these different guys around store experience, engaging the consumer with the products in the store. So all over the Radio Shack stores you see branded departments of headphones, branded departments of tablets and phones where you can play, you can experience and engage, but you are right that there's certainly still a reliant or inherent risk there. They're obviously in the very early stages of this re-imaging, so it'll be something to keep an eye on going forward, what they end up doing with these remaining 4,000 stores to be competitive.
Yeah, I listened to what you are describing leadership is saying, and when you say it, it sounds really good, but the stores I've experienced just don't live up to that ambition.
Yeah.
And I think going to Brookstone or something, that's an equally random collection of relatively overpriced products,
Mm-hmm.
but it draws people in, it's fun, and that's a format that after Sharper Image went away sort of found its footing. And I'm not suggesting it's a breakthrough success, but it's a different way to think about a store that's based in a mall, pretty small, has an eclectic assortment, and brings the assortment to life by always bringing the new and the weird and the entertaining to play with.
Yeah.
Well, Doug, we're going to try another new feature on the show this week, which is the request of the week. And since you're on the client engagement team, we thought maybe you could tell us what the most interesting question you got this week was.
Yeah, so for those of you that don't know, all of you that have access to RetailNet Group can send questions into our analyst team, things you're working on, trends you're focusing on, and kind of get do we have any current research on it, get our thoughts on it. And so we're constantly fielding those questions, and we welcome anyone that wants to inquire about that. But an interesting question that we got this week was around this growth and evolution of what I'll call U.S. bodega formats. It's it's specific Hispanic grocery supermarkets that focus primarily on a specific Hispanic consumer segment. So a sort of a misconception that people have out there is not everyone in the U.S. with a Hispanic background is shopping at these stores. The U.S. is roughly a quarter Hispanic at this point, but what we've found is that their target shopper is far more limited than that. So as people move to the U.S., immigrate to the U.S., and kind of become immersed in the culture, what ends up happening is at the early stages, they might be really interested in shopping at we'll call it a bodega that has a very similar experience to one that they might have right across the border in Mexico, Central America, Latin America.
So the store's got a name they recognize.
The store's got a name. It's they've got brands that they recognize, and the layout. It very much feels like it could be in Mexico, for example. It's really similar to one of those stores. But what happens is people slowly acculturate away from those stores. Maybe they keep some of their preferences that this original store was meeting, but they'll slowly transition to more mainstream supermarkets, more mainstream grocery outlets. And so because the U.S. population is becoming increasingly diverse, we do expect that this will continue to play a pretty big role. in in the U.S. grocery market, in particular in some states, some regions. So California, Texas. You talked about Winco. That's certainly something that they're going to encounter, and I think it highlights kind of the importance of sort of segmentation, localization, being relevant to a very specific segment of the population, because it's not good enough anymore to say those are our Hispanic shoppers, they all go to this type of store.
Right. I think, in any area you need to be able to segment the data to understand, is it what we'll call G1 or Generation 1 versus Generation 3. And as you get closer to Generation 3, that's when consumers start to acculturate. And so the big question for me for the bodegas, because there are many strong bodega competitors out there, or players, is how can you win on home brands, having the right relevant assortment that it would be much harder for a mainstream grocer to have. How do you have the relevant store experience and balance, features that will bring back in G3? So whether it's playing off of home or memories, having the right cultural calendar, I think there are ways to retain those shoppers, but it does become about a shopper retention strategy.
Well, the balance, we've looked at this from sort of both angles, right? I mean, we've looked first at how the big mainstream retailers, we've looked at this topic from a couple angles.
Right.
One angle is how the big mainstream retailers, mass, grocery, become more relevant, sometimes on a really local basis, to these fast-growing population segments. And we've also looked at it from the other angle, which is how do these bodegas, who are dealing with the acculturation that you mentioned, retain those shoppers over time.
Right.
And we've seen some of the big grocery players, Kroger and Walmart, actually launch dedicated formats with names like Supermercado, and we know Walmart has closed their dedicated format. Didn't one of the other big grocers just close? I may be misremembering it. It may be Sam's Club.
So Sam's Club closed Mas Club. Supermercado de Walmart, I believe, is still in operation.
Okay. I do know that at least a handful of these dedicated formats have closed.
Yeah.
And very few, if any of them, have actually scaled.
No.
So the prevailing thinking seems to be you definitely have to be relevant. You want personalized and relevant assortment, messaging, some one-to-one communications if you're able to identify that there's a household that fits one of these segments. But I also think it's pretty important to do more than just bilingual signage and be really precise about who you're speaking to. Because what I think we learned 4 or 5 years ago is you can't do this part-time. It's not a hobby. It's becoming more and more important, and you have to be pretty sophisticated.
You do, and it definitely drives up complexity for those that are trying to localize. It's very important, but from a complexity standpoint, I think it is a challenge, one to overcome, but it is a challenge.
And it certainly speaks to the sort of specialization that it really requires to succeed in it. So you talk about these people closing small formats. There's certainly an inherent advantage in understanding kind of what this target Hispanic shopper really needs, what they want, where, quite frankly, some of the big chains might not be able to replicate it. But what they do start doing is you see them starting to add categories or add products that are recognizable on the fringes. So we talked about Kroger and Walmart, and if you were to walk into a Walmart store in Southern California, you actually recognize a lot of those same brands put on end caps that people are consuming across the border in Mexico.
Yep. All right, team, what's up next?
So an exciting new feature coming to RetailNet Group actually next week is we're going to be launching how-to tutorial videos on our site. So when you're on key retailer pages, on market pages, there'll be a quick 30-second video that you can pop open and tell you sort of where to go, what you can find on this page, and how to navigate it. And it should make the end experience for consumers better.
Awesome. Hannah?
Working on UCLA, our advanced retail strategy program that's coming up in March. So we're starting to get ready for that and working on that. Working on the Small Store Summit, and then from a Latin America perspective, looking a little bit into digital and how that's starting to impact Latin America.
I'm looking forward to that. There's certainly a lot of questions we've been getting about that. And the other thing I'm excited to work on is at UCLA, I'll be presenting a big piece of work on couponing.
Mm-hmm.
There's a lot of questions about how the price promotional environment is evolving with folks like coupons.com IPOing. So the questions are, what are these emerging vehicles? Do they work independently of retailers or with retailers? How are brand manufacturers funding them? That is, what buckets of funding are we tapping into? What kind of redemption rates and lift and effectiveness are we getting? So we're just kicking this work off, and it's a pretty big piece of work, but I'm excited to learn a lot and share a lot when we get to UCLA next month.
Me too.
Well, thank you all for joining us in our second week. We're learning on the fly, so appreciate your patience and for tuning in. You can reach the analyst team at R&G at analyst@RetailNet Group. We welcome tips, feedback, suggestions, comments, and we'll see you next time. Have a good weekend.